Hello, good morning to all. Welcome to a brand new week ahead. And today is Monday, the 8th of January 2024. Welcome to today's dose of Market Insights by OANDA. I'm Kelvin Wong here, the Senior Market Analyst of OANDA Asia Pacific. Today will be Monday, the 8th of January 2024. And welcome to today's Daily Dose of Market Insights. So before we start our Daily Dose, let's take a look at the disclaimer slides first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product. And as well as any forecast, prediction, or projection in this document is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so before we jump into the current short-term technical outlook on the cross asset classes, let's recap on what are the key events that took place last Friday, which is the 5th of January, and as well as their impact on the performance of the cross asset classes. So actually there are actually three key events and data on the highlight on last Friday. Firstly will be the all-important non-farm payroll data. So let's take a look at the non-farm payroll data in terms of the economic statistics. All right, so as you all know that the non-farm payroll data is important. Why? Because it's one of the key metrics that drive the decision making of the US Federal Reserve, which in turn will actually starts to see whether there's a liquidity easing or liquidity tightening situation in the global economy. So last Friday, non-farm payroll data for December came in better than expected. The market added, the US economy added in 216K job added. So if I could expand my screen, so you could see much clearer. Okay, 260K job added, much higher than the 173K downward revised monthly job added in the month of November, and also surpassed expectation of 170K. So if you look at the headline number, it seems to be the US job market is still in a rosy situation. But however, if we dissect deeper into the non-farm payroll data, which consists of several key other elements that I want to highlight, is firstly will be the participation rate. All right, so the labor force participation rate actually declined by 0.3 percentage point, 0.3 percentage point, pardon me, to 62.5% in the month of December. So in terms of the monthly decline, this is actually the lowest in almost since 2020. Yeah, since 2020. So if you look at the 5-year trend, if I could expand my chart over here, it's actually in a declining mode. All right, in a declining mode right now. And also another key metrics on the US job data will be this US full-time employment data. So if you look at the full-time employment data, also deep as well, from 133,196K in December, it dipped from 134,727K in November. So this monthly decline in full-time employment also is the lowest that is being seen, or the steepest monthly decline being seen in the last 3 years, or last 2.5 years or so. So if you look at the 5-year trend of this full-time employment, also is also picking up as well. So what it means that over here is that if we dive deeper into the US jobs data on Friday, without looking just at the headline rosy number, these two key metrics, the participation rate and as well as the full-time employment data in terms of monthly levels, has started to pick up, okay, in the last 2.5 months or so. So what it means that the prior steep US Federal Reserve interest rate hike cycle has now taken a toll on the US job market. All right, so with that, we start to see expectation of the first US rate cut to come in as early as March. It still rather remains intact. So if you look at the Fed funds futures pricing or the CME Fed Watch 2, over here, this is the March FOMC expectation. Current rate is at 5.25% to 5.5%. Okay, market is still expecting around 63% chance that the Fed will start to act on March FOMC this year. That means to enact the first rate cut with a chance of 62 or 63%. So it's almost unchanged about a week ago, which is 73. Okay, slightly dipped down about 73%, but upon the ex non-farm payroll data release, the number didn't actually decline drastically to below 50%, despite the fact of the headline numbers being rosy. So market participation are actually aware that the certain aspect of the US non-farm payroll data that I highlighted to you all earlier on, the participation rate, the full-time employment number, these two key metrics are actually picking up. That means they are actually showing lackluster job data. If we dive deeper into the various aspect of the US job report, not looking just at the headline figure, non-farm payroll figure, okay, which is better than expected, but the participation rate has started to decline. The full-time employment number has started to pick up as well. So this actually is showing that the US job market is not so rosy, and which in turn start to see a bit start to continue to see dovish expectation of the Fed pivot, where market expected is still expecting above 50% chance of the first rate cut to come in as soon as March this year. So this is one of the key economic data to highlight. And over the weekend, we also start to see there's this Fed speak by Fed official Logan. So she's actually a non-voting member this year. But what she mentioned over here is that she did say that the Fed should slow asset runoff. That means QT. They still remember that the Federal Reserve interest rate hike coincide with quantitative tightening. So what she mentioned that she's concerned about the reverse repo starts to decline, who could actually put downside pressure in terms of liquidity condition on the tightening side. And if this reverse repo starts to decline, the Fed should actually slow asset runoff. That means slow down the pace of QT. So that is also signs of what I call dovishness from Federal Reserve officials thinking, even though she's a non-voting member. All right. So all in all, what we could see over here is that the Fed dovish pivot is still remains pretty much intact for this year, which potentially that actually explain on Friday why the US dollar strength actually tempered off after the release of the ex non-farm payroll data. All right, and also I want to highlight over here on last Friday as well. Let me share with you calendar. Okay, on last Friday, there's another data on the highlight. Previous week, yeah. Yes, this is the all-important ISM Services PMI. So if you look at the ISM Services PMI, why is it important? Because the US economy is driven by the services sector rather than the manufacturing sector. So the services activity in US actually temper off as well in terms of growth trajectory. Anything that is regarding PMI is a survey data. Anything that's above 50 is considered expansionary, but the rate of expansion has started to decline as well in December to 50.6 from the previous month of November at 52.7 and below consensus of 52.6. So if you look at the trend of the ISM Services PMI, it actually starts to temper off, and it's actually is the lowest rate of growth expansionary since the month of May this year. Since the month of May this year. So what it means that over here, services activity, yes, is growing, but the growth what I call it, the growth rate has starts to temper off in December. So that is also indicating to us that the services activity has starts to turn lackluster as well. So that is also kind of putting a bit of favor of this Fed dovish pivot to come into play in 2024. All right. So with that actually we start to see, number one, the US dollar strength starts to taper off. So if you look at this momentum of the US dollar in the last 5-day rolling, okay, give me a minute. Let me share. Yeah, this is the 5-day rolling performance of the US dollar as of right now today. What we could see over here is this is the push up initially exposed. Then after that, exposed NFP data came down, and this morning it attempt to actually temper off as well. All right, so the strongest dollar performance is against the yen, but however the peak was at 3 point, around 3 point, okay, give me a minute, yeah, around 3 point, okay, where is the number? Yes, this number here, around 3.2% level. Then thereafter, this is the peak of the dollar yen outperformance. Then thereafter, it outperformance start to dwindle down to 2.36% right now, and the dollar is the underperforming or the worst performing against the sterling dollar, at almost unchanged at 0.15%. Okay, and also net, if you look at the US 2-year Treasury yield premium, has also started to string against the rest of the world, taking into account of the average 2-year bond, the average 2-year sovereign bond yield of Germany, UK, Japan, Canada, Swiss, AU, and China, from a peak at about 1.85 over here. Okay, 1.81, it strings down to 1.74%. Okay, so net is also supporting this this US 2-year Treasury yield premium shrinkage, is also supporting this ongoing dollar strength. We call it dissipating since last, that was actually evidence last week. So potentially we could start to see resurgence of dollar weakness coming back into play, which I'll later share with you on the short-term technical outlook chart. And given the fact that the dollar strength starts to dissipate, expose NFP, we start to see a recovery in the US stock market as well, where the S&P closed with a slight gain of positive 1.8% last Friday. The Nasdaq 100 0.15%, the Dow Jones Industrial Average almost unchanged at 0.07%. 0.07%, but while the Russell 2000 continued to show weakness at negative 0.34%. So if you look at the heat map of the S&P 500 on last Friday, we could see signs of recovery in the S&P 500, given the fact that the weakness is still prevalent on the technology sector, which is the mega cap US stock. But some signs of improvement has started to show on the mega cap US stock, especially on Nvidia is up 2.3%, followed by Amazon positive 0.4%, and Meta up positive 1.4% yesterday, on last Friday. So what we could see is that last week of mega 7 weakness that actually hit the Nasdaq 100 has started to show signs of what I call at least some kind of short-term recovery coming into play, given the fact that the dollar strength that was seen early part of last week has started to temper off after the release of an important exposed NFP data. All right, and also one important fact I want to highlight to you is this geopolitical tension that is kind of taking a bit of headwinds on the China stock market at the start of today's Asia session. Is China has sanctioned 5 US defense firms on Taiwan arms sale. All right, so that actually boils down to the picture that geopolitical tension continue to remains on the forefront between US and China. So that's actually driving this ongoing China stock market weakness that is seen right now while I'm talking to you. So if you look at the current stock market in China, the Hang Seng Index is actually down 1.9%. Hang Seng Tech negative 3%. The HSCEI, the China H shares is down negative 2.4%, and the China CSI 300 is down negative 1% at this point in time while we are talking. So for sure, this this is being inflicted by this ongoing China US tension is still on the forefront at this in 2024, especially when we start to see the US presidential election start to heat up in the second half of this year. All right, so that's pretty much sum up on the data, the key data and event and its impact on the cross asset classes. The market is down to highlight. So now let's immediately jump into the short-term technical outlook on the various asset classes, starting from the FX market first. All right, so let's start from the FX market. So let's start with the European currency. Okay, so let me expand my screen so that you guys could see. Okay, euro dollar. So on the euro dollar, the market actually rebounded right at the short-term pivotal support level that we highlighted on last Friday, 1.089. So no change for sure. This 1.089 will be our short-term pivotal support to maintain that short-term bullish outlook on the euro dollar. First resistance to watch will be the 110 figure level for sure. Last Friday, almost coming to the close, the US session, it almost hit this level before pulling back throughout last Friday US session, but managed to actually flirt around the 20-day moving average at the close. And in fact, right now, I also attempt to actually trade around the 20-day moving average in today's Asia session. Okay, so no change. These will be the two key levels to watch, still maintaining that bullish outlook above 1.089 pivotal support level on the euro dollar. Clearance above 110 level is needed to kind of ignite a much more pronounced bullish pressure on the euro dollar to test the next resistance at 1.1060. Only an hourly close below 1.0890 will invalidate this short-term bullish outlook to see the extension of this minor corrective decline towards the next next support level, pardon me, at 1.0820, which confluence with this medium-term ascending channel from the low of 4th of October 2023 low. So that's for the euro dollar. Sterling dollar, much more stronger than the euro dollar. Why? Because price action clearly surpassed the 20-day moving average after a test on the right above the pivotal support at 126 figure level. All right. So with that, since price action is not able to break above 127.60, pardon me, on the sterling dollar, 127.60 sterling dollar. So I would not want to be tighten the pivotal support level to too tight at 126.50 for today. All right, so I will use this 126.50 as an intermediate support level. 126 figure level will be the clear short-term pivotal support for now at this point in time, unless we start to see a clearance above 127.60. So no change. 127 figure level will be my short-term pivotal support level. Maintain that bullish outlook, short-term bullish outlook on the sterling dollar. Clearance above 127.60 exposes the swing high area of 28th of December at 128.20. Above it sees the next intermediate resistance coming in at 129.40. Only an hourly close below 126 figure level will invalidate this short-term bullish outlook to see the extension of another leg of a minor corrective decline to test the 20-day and the 50-day moving average that is coming very close to a graphical support level, the next graphical intermediate support level, which is this graphical support here, the minor swing low of 8th of December and 14th of December at 125 figure level. That's confluencing very closely to the 200-day moving average and the 50-day moving average as well. So net overall, still maintaining that short-term bullish outlook on the sterling dollar. Now, Asia Pacific currency, let us start with the dollar yen first. The all-important dollar yen. Why is it important? Because this is the strongest performance of the dollar against the major pair. So if the leaders start to show weakness, it should actually drag down the rest of the major currency as well. That means dollar's weakness throughout the board. All right, i.e. yeah. So right now, what's interesting over here is that this push up 5-day rally from the low of 28th of December. Okay, from the low of 28th of December of 140.25 to a high of this close to this 146 figure level, which is a rally about 4.09%, 4.9%, has started to show signs of bullish exhaustion. Why? Because price action has started to form a long-legged doji on last Friday, right at a key inflection level. What inflection level is a bearish reversal level, 14670, which is very close to this downward sloping 50-day moving average, okay, as well as former swing low area of 29th of December all the way to 4th of December, and also as well as the 50% Fibo retracement of this ongoing medium-term downtrend phase since the high of 13th of November last year. Okay, close to 50% Fibo retracement. So, i.e., what it means that this 5-day of rally from the low of 28th of December is rather skewed towards a minor corrective decline within a medium-term downtrend phase of the dollar yen that is still intact since 13th of November 2023 low, rather than the start of a bullish impulsive upleg to see fresh new high above 13th of November 2023 high. That means, i.e., what we are seeing right now is a potential tipping point of the start of a fresh impulsive down move of this medium-term downtrend phase that is still intact since the high of 13th of November 2023. Also supported by the daily RSI that is trying to actually now retrace or retreat off this corresponding descending resistance at the level of 55 level. Okay, so that's for the daily time frame. So if you look at the hourly time frame, it's much more clearer in terms of the the short-term momentum. So if you look at the short-term momentum on the hourly time frame over here, the hourly RSI momentum indicator has clearly broken down this parallel trend line support level. Okay, also correspond with the low of 30th of 29th of December, 28th of December, all the way up to the high of last Friday. It has already broken down below this short-term this parallel ascending support, which is at around 65. And prior to this breakdown, the RSI has started to flash a bearish divergence as well. Okay, indicating to us that this upside momentum that is carrying this short-term upside momentum that is carrying this push up from the low of 28th of December has starts to lose initial. That means no more upside momentum. The potential now is more skewed towards further potential downside on the dollar yen. So for sure, 14670 short-term pivotal resistance level. As long as this level is not surpassed to the upside, a breakdown below 14375, which is close to which is last Friday's swing low, could potentially ignite further downside pressure, at least in first step towards 14220 level in short term. All right, so flipping to a short-term bearish outlook on the dollar yen, holding below 14670 with a downside trigger level at 14375. Only an hourly close above 14670 will invalidate this short-term bearish outlook on the dollar yen to potentially see a squeeze up towards the next resistance at 14745, followed by 14830. Lastly, Aussie dollar. So Aussie dollar, very interestingly, also managed to shape a bullish reversal right at this 6670 slash 6670 slash 67 figure pivotal support level. And also the price action on the hourly RSI also has started to shape a bullish divergence as well, right after last Friday exposed non-farm payroll data. And also, if you look at where the price rebound, it actually rebound off the 38.2% Fibo retracement of this former of this ongoing medium-term uptrend phase from the low of 26th of October all the way up to the high of 28th of December. So with that, we'll be using 6770 short-term pivotals, a bit of adjustment to for our short-term bullish outlook for today, as long as 6670 short-term pivotal support is not surpassed on the downside on the Aussie dollar. The next resistance to watch out for will be 6770 in the near term. A breakout above 6770 exposes the next intermediate resistance at 6835, which is the minor swing high of 29th of December, 28th of December, 29th of December, and 2nd of January. All right, only an hourly close below 6670 will invalidate this short-term bullish outlook to see the continuation of this minor corrective decline to test the next support zone at 66 figure slash 6570, which is corresponding with the 20-day and the 50-day upward sloping moving average as well. This graphical support zone over here, and as well as the medium-term ascending trendline support that is still in place since 26th of October 2023 low. All right, so still maintaining that short-term bullish outlook on the Aussie dollar as long as 6670 short-term pivotal support holds. Now, stock indices. So for the stock indices, let's start with the Hang Seng. So Hang Seng right now is pretty much bearish for today. So price action has really started to break down and now approaching a key short long-term pivotal support level at 16,100 level. So with that, I'll be turning neutral instead Okay, so turning neutral right now between this, okay, why this level is important, later I'll highlight on the weekly chart again. Okay, so turning neutral between 16,100 and this level over here. Okay, between 16,500 and 16,100, only a breakdown below 16,100 will expose us to the next support level, okay, which is this level here, 15,500, the congestion area of 2nd of November and 31st of October 2022. All right, so why 16,100 are turn neutral instead of attempting to actually see a bearish push down below 16,100? Because if you look at the long-term chart of the Hang Seng Index, if I go to the monthly chart of the Hang Seng Index, this 16,100 is in fact the long-term circular trend line right now acting as a support level at 16,100 that is in place since the Asia financial crisis low of October 1998. All right, that was tested and survived on the 2nd of May 2023 during the great financial crisis of October 2008 inflicted by the US subprime mortgage crisis, and as well flirted around it during October 2022, about 1.5 years ago. This is during the China stringent COVID-19 lockdown, and as well as the China central government crackdown on the China big tech sector. Then price action managed to stage a rebound thereafter and survive again during the later part of during December last year as well. Okay, so this is in fact a key support level to watch. So that's why I decided to turn neutral instead of outright bearish push down below 16,100. All right, and so given the fact that the hourly RSI starts to flirt around the oversold region as well. So neutral between 16,100 and 16,500. So for sure, an hourly close above 16,500 bring back the boost to actually see a potential corrective rebound scenario towards 16,950 slash 17,160, which correspond to the downward sloping 50-day moving average and as well as the minor swing high area of 28th of December to 29th of December. All right. So that's the outlook for the Hong Kong 33, flipping to a neutral bias for today, missus. Okay, US benchmark stock indices. So let's start with the Dow Jones Industrial Average first. So Dow Jones Industrial Average, US Wall Street 30 on last Friday, we do have a slight bearish bias, very close to 36,170, which is also the 20-day moving average. So price action managed to survive right above, right at the test of the 20-day moving average before rebounding. Then thereafter, it started to give back gains throughout the US session. So with that, I will be using a bullish bias for today, using 36,170 as my short-term pivotal support level, given the positive push out on last Friday. So as long as this level is not surpassed on the downside, potentially the US Wall Street 30 could see a retest at this minor range resistance of 37,800 in the first step. All right. Only an hourly close below 36,170 will invalidate today's short-term bullish bias to see the continuation of this minor corrective decline within its medium-term uptrend phase as price action going to trade above the 50-day moving average towards the next support level at 36,810 in the first step. Okay, so flipping to a bullish bias for today on the US Wall Street 30, as long as 36,170 short-term pivotal support is not being surpassed on the downside. Now, the Nasdaq 100. So Nasdaq 100 last Friday came down and almost hit the support level that we highlighted at 16,160. So that was the level that we have on our bearish bias on last Friday. So after a test on this 16,000, close to this 16,160, what we could see over here is the RSI has started to shape that bullish divergence as well. And it starts to do a bullish breakout over here. Okay, a bullish breakout from this descending parallel descending trend line on the RSI, on the hourly RSI. So indicating to us, right, the the findings from the hourly RSI momentum indicator has started to suggest that this minor corrective decline from the high of 28th of December all the way down to last Friday low is losing downside momentum. That means losing downside momentum increase the odds of at least a short-term rebound in the first step. All right. So whether this rebound will translate to a much more pronounced impulsive up move phase at this point in time, I can't decipher because there's not enough element. But for sure, the support level to watch for today will be 16,160 short-term pivotal support. So I'll be flipping to a bullish bias given this positive element that starts to emerge on the hourly RSI momentum indicator, at least in the first step towards 16,500 slash 16,580, the resistance level to watch for this potential bounce over here, which confluence with the 20-day moving average now acting as a resistance level, and as well as the former minor ascending channel support now turns into the pullback resistance as well at 16,580. And if we do the Fibo retracement from the high of 28th of December all the way to last Friday's low, it also confluence with the 50% Fibo retracement. So net all in all, we'll be flipping to a bullish bias as long as 16,160 short-term pivotal support level is not surpassed on the downside of the Nasdaq 100 in first step to expose the 16,500 slash 16,580 resistance zone. All right, only an hourly close below 16,160 will invalidate this short-term bullish outlook for today on the Nasdaq 100 to see the continuation of this minor corrective decline to test the 50-day moving average now acting as a support level at 15,910. All right, so now lastly, German 30. So for German 30, price action also hit the support level that we highlighted, which is at 16,400, 16,460 level. So with that, the way the price action hit this level, also the hourly RSI has started to shape a bullish divergence as well. So indicating to us that the decline from last week has started to lose downside momentum. So with that, we'll be flipping to a bullish bias on the German 30 as well. 16,440 short-term pivotal support level. As long as this level holds, potentially the German 30 could retest the near-term resistance zone at 16,720 slash 16,790. We also confluence with the 20-day moving average now acting as a pullback resistance, and as well as this former minor ascending channel support from 7th of November now acting as a pullback resistance as well in this resistance zone. And if we do the Fibo retracement from last week high all the way to Friday's low, it confluences with the 61.8% Fibo retracement. All right, so flipping to a bullish bias as long as 16,440 key pivotal support holds to test the near-term resistance zone of 16,720 slash 16,790. Only an hourly close below 16,440 invalidates this bullish recovery scenario to expose the next support level at 16,300, and below it exposes the 50-day moving average now acting as a support level at 16,060. All right, now spot gold. So for spot gold over here, what we could see is this. All right, so spot gold no change. The 16 the what the 20,030 2030 level is indeed a short-term pivotal support level, tested, rebounded the 20-day, also 20-day moving average, but hit the near-term resistance and it starts to see profit taking. So for sure, these are the two levels to watch for today as well in terms of short-term bullish outlook. So still maintaining the short-term bullish outlook on spot gold as long as 30,030 short-term pivotal support holds. First resistance to watch will be 2060. You need to have an hourly close above 2060. Then we will see much more pronounced upside momentum start to creep back into gold to retest the 28th of December minor swing high at 2090. An hourly close below 2030 will see an extension of this minor corrective decline to test the next support level at 2015 slash psychological level 2000 level. We saw confluence with the upward sloping 50-day moving average. Okay, then lastly, WTI crude oil over here. Oops. Okay, WTI crude West Texas oil. So West Texas oil, still no change over here. Okay, so what we could see on West Texas Oil is it managed to pierce up on last Friday before retracing again. So I do not want to put my short-term pivotal support to be so tight, which is close to the 20-day moving average. Okay, because it's still oscillating within this range configuration. So the near-term support will be at 72.40 for sure, which the this 20-day moving average. But I do not want to put it so tight because the last few sessions you see a wild swing uh, around this 20-day moving average. So no change, 70.90 will be the still the short-term pivotal support level. So as long as 70.90 short-term pivotal support holds, potentially the West Texas Oil could shape another potential bounce towards this intermediate resistance zone of 74.95/76.05. We also correspond with the 50-day moving average still acting as a resistance, a downward 50-day moving average, and as well as the minor swing high of 27th of December, which is this zone of 74.95/76.05. Only an hourly close below 70.90 would invalidate this short-term corrective rebound scenario to see a further slide to test the medium-term support level at 68.90. Below it, see 67.55/67 figure level. Okay, so that's pretty much sum up for the short-term technical outlook across the different asset classes. So what are the key economic indicator to look out for today? So today is a rather quiet day in terms of market data. So the only data we look out for will be Eurozone economic sentiment for December out at 6 p.m. Singapore time, and the retail sales month on month for November. This is the finalized one at 6 p.m. Singapore time. And throughout the US session is rather quiet, with the fact that only at 1:30 a.m. Singapore time we have a Fed speak from Fed official Bostic, and earlier on Wednesday, Tuesday before 11 a.m. That means before our daily dose of market insight at 7:30 a.m. We have two key Japan's data to watch will be household spending and as well as the leading Tokyo core CPI data for December. That will be out at 7:30 a.m. Singapore time tomorrow. So with that, that's pretty much sum up of today's daily dose of market insights. So I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.